by 3.7% year on year, while declining 0.8% sequentially. Both of these and all other financials I share on this call are all in constant currency. On a year-on-year growth, it was driven by several verticals, including technology, telecom, media, retail and CPG, and financial services. Geographically, it was driven by rest of the world and Europe. We observed that the environment remained stable from an overall perspective, with some variations across specific verticals. It also did not deteriorate as feared at the start of the quarter. Our operating margin came in at 16.3%, which was lower than our plan. While Q1 has been historically the weakest quarter for us, the below plan operating margin was driven by the fact that our utilization dropped due to a delay in ramp up for a specific program. We encountered ramp downs in specific areas, which resulted in a larger bench due to also productivity benefits that we brought about. And it was also due to demand supply mismatch between skills and locations. We also had a one-time impact from a client bankruptcy. In spite of all this, we remain committed to making and in some cases accelerating our investments in generative AI capabilities and go-to-market capabilities. Our segmental performance, IT and services business grew 4.5% year on year, while declining 0.1% sequentially. ITBS services grew 3% year on year. ERS business grew 11.8% year on year. HCL software had a weak quarter after several quarters of good performance. It declined 3% year on year. However, the annual recurring revenue ARR, which stood at 1.06 billion, was a 1.3% increase year on year, which augurs well for the future as we are consciously working to improve our subscription or SaaS revenue. KK will talk about this a little later. As far as verticals go, our top performing verticals were technology and services, which grew at 13.7%, telecom and media at 13%, retail CPG at 8.2%, and financial services at 6.8% year on year. We had very impressive client additions. We added 6 clients in the 50 million category and 11 clients in the 20 million category on a year-on-year basis. On a QOQ basis, we added clients across categories, including 2 in $50 million category, 6 in $20 million category, 4 in $10 million category, and 8 in $1 million category. These healthy additions to our client portfolio were across verticals and geographies. Coming to our bookings, we had a decent quarter. Our net new bookings for the quarter was 1.8 billion. We also won a large consolidation deal in financial services this quarter, which is not accounted for in the TCV value for Q1. Bookings were good and well balanced across service lines, geographies, and verticals. We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. The delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter. Our portfolio is incrementally getting more balanced across service lines, geographies, and verticals than it was a few years ago. We continue to win more in the digital business and engineering and R&D services, an agenda we had set for ourselves as a part of our medium-term roadmap. Our pipeline continues to remain strong. Our digital business is seeing a number of large deals due to our engineering-led approach, a very strong client conviction on our AI propositions, and the platform capabilities that we have built through AI Force, AI Foundry, AI Labs, and AI engineering, as well as our deep data and AI capabilities. There is a healthy demand for efficiency-led opportunities across the board. The discretionary spending varies across verticals. Clients are continuing to spend on AI-led transformational propositions in both software development and IT operation services. The share of AI and Gen AI continues to grow as they become critical in nearly every deal. Gen AI is now central to IT services strategy. Agentic AI is gaining traction, especially in operational efficiency and application modernization program. Our focus on long-standing strength in application modernization is a key contributor to our growth in our pipeline. Incorporating AI is helping us build upon this strength, and we are also investing in an AI-driven data lifecycle management platform. On the people front, our headcount stands at 223,151, a slight reduction over the previous quarter by 269 people. Our IT services voluntary attrition on an LTM basis is at 12.8%, lower compared to the previous quarter. I will touch upon a little bit more on our AI and Gen AI performance, and we believe this performance can be measured across three strategic dimensions of ecosystem, offering, and client engagement. When it comes to the maturity of our enabling ecosystem, our market momentum has ensured that we are perceived as a very attractive partner to leading tech OEMs, ISVs, hyperscalers, and pioneers like OpenAI. During the quarter, we announced a strategic partnership with OpenAI to drive large-scale enterprise AI transformation as one of their first strategic services partners. We are well positioned to take advantage of the enterprise AI spend as we work towards developing the most comprehensive ecosystem. This quarter, we also announced a partnership with UiPath to accelerate agentic automation. We launched a suite of agentic AI solutions in collaboration with Google Cloud and integrated NVIDIA AI Enterprise with AI Force and NVIDIA Omniverse with our physical AI solution, Smart Twin. We were named a market leader in the HFS Horizons Generative Enterprise Services 2025 report. ISG recognized us as a leader in advanced analytics and AI services. We were cited as a leader in IDC's MarketScape for Worldwide Data Modernization Services 2024 vendor assessment. We were recognized as a Microsoft Responsible AI partner. We won top honors as an AWS Gen AI Premier League Awards 2025. On the offering maturity, HCLTech was the first among its peers to launch a full stack of AI portfolio featuring AI Force, AI Foundry, AI Lab, and AI Engineering. These offerings are designed to drive end-to-end service transformation and value stream innovation for our clients. They are now being embedded in most of our large clients and also in the deal pipeline. And the third dimension of the AI strategy is the client engagement. We are witnessing the size of our engagements increasing steadily from exploratory POCs to strategic multi-million-dollar partnerships. For example, we signed a multi-million-dollar engagement with one of the largest Australian logistics companies for AI-led service transformation using AI Force. A leading Europe-based telecom firm selected HCLTech to transform its digital foundation and your application landscape. This partnership will enable zero-touch operations with hyper-automation across the entire IT operations landscape, powered by Gen AI, again using our AI Force platform. We continue to win many recognitions and accolades from the market analysts, investor, and the investor community. We are the only service provider positioned as customer's choice in all 6 Gartner Voice of the Customer Magic Quadrant evaluations related to IT services. This is the first time any service provider has achieved this incredible recognition. HCLTech is among Asia's most honored in Excel 2025 executive team rankings. For the second year running, HCLTech was the most decorated India headquartered IT services firm in the survey. Now, looking ahead, we are improving our revenue guidance now for FY26 2 to 5% in constant currency, which is better than due to the better performance in Q1 and the outlook for the remaining quarters. On margin guidance, we are adjusting our EBIT guidance to 17 to 18% due to the factors I mentioned earlier, like the unanticipated impact in Q1 for the same reasons that I mentioned earlier, which will continue partly into Q2. And the second reason is continued and accelerating investments in AI capabilities and go-to-market to ensure we're able to make the best out of the strong pipeline that we have. And one additional factor, we plan to execute a restructuring program both on the people and the non-people side during the rest of this fiscal year. The one-time costs because of this are baked into the above guidance. We are doing this to provide us the structural agility to address the market demand in the AI era. We are optimistic about meeting our revised guidance, supported by our superior revenue growth and positive booking expectations for the upcoming quarters. This outlook is further reinforced by our consistent track record of strong operational execution demonstrated over the last several years. With this, I would invite Shiv to walk us through the financial details.
Thank you, CVK. Good evening, everyone. Thank you for joining our Q1 financial year 26 earnings call. Let me walk you through our financial performance for the quarter. Starting with the revenue performance, total revenue for the quarter is at rupees 30,349 crores, which is a growth of 0.3% quarter-on-quarter and 8% on a year-on-year basis. Coming to the services side, services revenue came in at rupees 27,628 crores, which is a growth of 1% quarter-on-quarter and 8.9% on a year-on-year basis. Software revenue for the quarter came in at rupees 2,826 crores, which is a growth of 1.3% on a year-on-year basis. Now let me share the details on profitability. Our EBIT came in at rupees 4,942 crores at 16.3% of revenue, and net income for the quarter is at rupees 3,843 crores at 12.7% of revenue. Moving on to return on invested capital, ROIC. Our ROIC continues to improve thanks to our ongoing focus on profitability and efficient capital management. The last 12 months ROIC is at 38.1% for the company, up 353 basis points year-on-year, and services ROIC is at 45.2%, up 236 basis points year-on-year. Software continued to improve with ROIC at 20.8%, up 473% year-on-year. Let me also share the details on our strong cash generation. Our cash generation remains very strong. Over the last 12 months, operating cash flow reached at rupees 21,838 crores, while the free cash flow generation was at 20,563 crores. Our balance sheet remains strong with gross cash at rupees 29,636 crores and net cash at rupees 27,343 crores. Operating cash flow to net income conversion is healthy at 129%, and free cash flow to net income conversion is at 121%. Our DSO, including unbilled, is currently at 82 days, which is flat year-on-year. Now, for the shareholders, the diluted EPS for last 12 months came in at rupees 62.57, which is up 3.4% year-on-year. The board has declared an interim dividend of rupees 12 per share for the quarter, and the record date is 18th of July, and the payment date of the same shall be 28th of July 25. That brings our last 12 months payout at INR 60 per share, effectively distributing 95.8% of our net income. That's all from my side and for now. And I would like to hand over the discussion to Kalyan Kumar for an update on HCL Software. Thank you. Over to you, KK.
Thank you, CVK. Thank you, Shiv. Good morning, good afternoon, good evening, everyone. I would like to share an update on how the HCL software strategy is evolving based on some of the insights which CVK did share in his starting commentary. So the primary sense as we are seeing as a software ISV, we are seeing a significant traction on agentic AI-based experience interactions. We're seeing some new business models emerging around what we are seeing as services software, where need to drive more outcome from using agentic rather than traditional subscription-based models. And the third very important thing which we are seeing is this need for digital sovereignty, which is how do you address the complex national, local regulations which are coming in across our customer landscape. So three big things our customers are talking to us. The first thing is that digital and business are the same. So saying digital is equal to the business, any technology stack which is powering that needs to start to look at experience orchestration, how do you bring human in the loop, but bring AI first into the product. So rather than adding AI, bake AI into the core of the product. The second is we're seeing a very different ask on consumption models, which is both cloud consumption, as a service models, moving away from traditional perpetual licensing. Maybe that's still applicable into certain segments in the government and public sector. Other than that, we're seeing that demand coming in a different way. So hence, how do you deliver your software with partner ecosystem, with the hyperscaler ecosystem becomes extremely important. And the third, data is becoming the center of every conversation. How do I unlock intelligence from the data which is being delivered from the software products? How do I have access to open data? How can I plug in, bring my own models, but also leverage your own models to the whole thing? So to address this, we have released this blueprint and we are reorienting we've reoriented our portfolio to something called the XDO blueprint, where X stands for experience, D stands for data, and O for operations. And each one of those pieces, we are infusing a lot of agentic capability with agents of action, which is agents of experience to drive better human-in-the-loop experience, agents of data to help provide better data intelligence, metadata management, data catalog, and agents of operations, where the goal is, can we move towards the level 5 stage of autonomous agentic ops, both for IT operations and business operations. So building the software engineering, the product pipeline to support that. Some key themes which we are trying to drive is, can we redefine experiences, reinvent operations, and help reimagine the way data is being used. Some of the key products enabling this blueprint on the experience stack, we released the HCL Unica Plus in start of June, a completely rewritten Unica stack with 16 different application modules with native CDP, AI capability, data sovereignty. It's been proven by one of the world's largest hybrid CDP deployment of over 720 million profiles, which got activated last month for one of the largest bank in Asia. The same thing goes with our total experience platform with our DX Compose and our MX engine with a lot of Volt IQ and agentic enablement around that. A significant amount of work is happening around the intelligent operations space, where we have market-leading products like HCL BigFix, HCL AppScan, HCL Workload Automation. They are now being infused with significant GenAI agentic capability, along with the GenAI Studio, where customers could author or partners could build and expand on top of the ecosystem, and with open standard support for MCP and A2A protocols, which allows us to really be open in a true sense in a currently very complicated software stack landscape. We're seeing significant adoption of the ACTI and data intelligence platform, which was built on top of the Xenia product line. And we're seeing a significant push towards metadata management, data governance, data marketplace, and activities around that. We've been recognized by quite a lot of analysts, all the big analysts around our HCL Uno platform, which is enterprise orchestration, which allows you to orchestrate enterprise systems, cloud, SaaS, but also allow you to orchestrate LLMs, orchestrate different AI agents, and ability to thrive in a multi-vendor, multi-agent, multi-software landscape, which is going to be the reality in large enterprises. And lastly, a very, very important release, we announced Domino 14.5, a true sovereign collaboration platform, which we use the word called true sovereign because it allows full control back to the customers, especially in public sector, defense, law enforcement, justice, different agencies who are extremely interested to manage their messaging, collaboration, secure communication. So you'll see continuous investment, including support for private AI, private LLM, offline deployment of AI capabilities. In summary, our strategy to empower our customers around how do we really push towards hyper-personalization, unified data management, and also enabling this whole agentic AI using a service as software consumption models is a big, big push for us, along with supporting the choice of sovereignty and deployment.